We all know that real estate is inherently local. However, a strange trend is unfolding in the United States. While the broader market remains highly competitive and optimistic, one particular region is undergoing a massive correction. This has led many to speculate that a major crash might be on the horizon. Though the rest of the country appears stable, the signs of instability in this area hint at deeper issues that could spell trouble ahead. To understand how people are coming to this conclusion, it's crucial to turn to a leading expert in the field and not just some YouTuber babbling on about stats. This is Robert Shiller. Shiller is a renowned economist, academic, and author who has made significant contributions to the study of real estate markets. If there's anyone who has extensively studied real estate trends dating back hundreds of years, it's Robert Shiller. His book, Irrational Exuberance, first published in 2000, served as a predictive warning to investors about the overheating housing market, which eventually led to the 2008 financial crash. Shiller's insights and indicators have proven invaluable for understanding and predicting market dynamics. By analyzing historical data, psychological factors, and economic indicators, Shiller provides a comprehensive framework for assessing housing market conditions and potential risks. So, how did he predict the last crash? And what can we learn from that to anticipate today's market? It turns out that in his book, he focused on three main factors: rapidly increasing home prices, price-to-income ratios, and speculative buying. Let's break these down to understand why some people think another 2008-style crash is on the way. First, let's examine the number one point: rapidly increasing prices. There's no doubt that home prices have surged well above normal levels. However, Shiller's Case-Shiller Index, commonly referenced on the St. Louis Fed website, doesn't fully capture the extreme nature of this surge. Currently, we're experiencing a significant increase in prices across nearly every state, from California to New York, with even more severe rises in southern states. The Case-Shiller Index, at least the one covered by popular media, only covers 10 metro areas, with Miami being the only major southern city included. The limited scope, unfortunately, doesn't reflect the full extent of the market's volatility. For example, in Miami, from roughly July 2001 to June 2006, the Case-Shiller Index increased by 136% right before the bubble burst in the 2008 crash. This period, which I'll call the '08 buildup, lasted about 5 years. In the most recent buildup, from around summer 2019 until now, prices have risen about 85%, signaling a similar trend. While the growth hasn't been as extreme, when you factor in interest rate changes and insurance changes in Florida, it can be argued that this recent buildup is just as concerning as the one in the early 2000s. And in other southern cities, the story is the same. People are frustrated with the rapid growth this region has experienced over the last 5 years, and it doesn't seem to be reversing anytime soon. If we judge the market based on the factors outlined in Shiller's book, Irrational Exuberance, it's not unfair to say that this market easily ticks the first box of a bubble: rapidly increasing prices. Now, let's move on to the second box: price-to-income ratios. Throughout the country, affordability is plummeting. The price-to-income ratio measures how much a typical person earns and what percentage of that income they need to spend to afford a typical home. Breaking this down by region and using Miami as an example, you can see that affordability is far below historic levels. This means people are financially stretched to own a normal home, or there's a lot of speculation and outside money entering the market, expecting equity to continue rising. This is seen as typically unsustainable and is yet another piece of evidence that we may just be in a bubble. Now, back to Shiller for a second. He's recently gone on record to say that prices are getting out of control. In an interview with CNBC last March, he told the audience that clearly they should consider waiting to buy, as prices would likely cool off. So far, he's been wrong, but that doesn't really change his rationale. Take a listen to him.
Hiking 25 basis points at its last meeting, despite the recent bank failures of SVB and Signature. And as borrowing costs rise, what will the ripple effect be on residential and commercial real estate? Joining us now, Yale Professor of Economics, Robert Shiller. Professor, we're so happy to have you on the show today. We're going to get a bevy of housing data this week, including Case-Shiller Home Price Index tomorrow. We have this brewing debate about whether we've seen a bottom or even at least a stabilization in the housing market. How do you see it?
Well, it's easy to forecast the short run in the housing market. Not so easy to forecast if you're a long-term buyer. It's not clear. But home prices are very, very high, and by historical standards. I would extrapolate the downturn somewhat. It's going to continue. Maybe if you have a chance to delay your purchase, it might be a good time to do it. You might get it a little cheaper after another 6 months.
I want to shift gears a little bit because you're one of the founders, you're one of the fathers of behavioral economics. And I want to get your thoughts on the banking turmoil that we've seen over the past several weeks, what it's going to mean to future credit availability, and just the role that behaviors, that attitudes have played in everything we've seen unfold.
Yeah, in my book, Narrative Economics, I talk about narratives regarding financial panics or bank runs. And these were perennial narratives in the 19th century. As the century wore on, they got stronger and stronger. I think that that's what a bank run kind of helps. It helps if the narrative is that banks are endangered. And so eventually Congress in 1913 had to put a stop to this. Like people were so worried about their banks, so they created the Federal Reserve. But even that, we give the Fed a really tough problem, how to deal with this fundamentally psychological reaction to a narrative.
Robert, I want to go back to housing for a moment. How does this affordability standoff that we see in residential real estate end? I mean, we've got extremely low inventory, high interest rates. Is it going to take higher unemployment to break landlords' ability to increase rents? And from there, the investments don't pencil out anymore, and therefore they got to dump them, and inventory rises and prices drop, or something else?
Yeah. Well, that's the capitalist system with a central bank. I think it works pretty well most of the time. And I wouldn't tinker too much with it. We have smart people on the Fed, and the Treasury Secretary I admire, Janet Yellen. They may have to accept, however, I think this is as Jerome Powell has put it, they may have to accept something of a recession.
But for the housing market, how should the people at home who are maybe thinking about selling a home, you kind of addressed thinking about buying a home, how should they expect this to play out? If you have a chance to sell your house now, even if it's for a little less than you wanted, do you go ahead and do it because higher inventories are inevitably coming?
I wouldn't say inevitably. I would say that it's likely to be some more declines. So, but I hate to, home purchase is such a family decision. I hate to overreact. So we do have a declining market at the moment. But, there are costs to not selling at the right time, the convenient time, or you might lose a house that you liked to somebody else. So I don't think it's an easy answer to that question.
When these price-to-income ratios go beyond historical norms, rapid normalization often occurs unexpectedly. People know that now is a horrible time to buy, and this sentiment is reflected in the University of Michigan's Consumer Sentiment Survey, which has tracked home buying conditions since the 1960s. Looking at the long-term chart, it's clear that we're essentially at an all-time low for buying conditions. Never before in history have people been this pessimistic about their ability to buy, and that's going back almost 60 years. That checks box number 2. Now for the last point, speculation. It's true that in the early 2000s, especially in Florida, there were loose regulations that allowed people to borrow excessive amounts of money and engage in fraudulent activities. Many shady individuals were involved in practices that made them a lot of money. This created an environment where people turned a blind eye to fraud and greed. It's almost unquestionable that prior to the last big bubble, there was much more speculation in the real estate markets. Overall, you can see that Robert Shiller's points on the early 2000s market, which included excessive price rises, price-to-income imbalance, and speculation, are evident in today's real estate market. While I don't believe Shiller has explicitly called this market a bubble ready to implode, we can say that some of the same conditions he used to make his argument in 2000 are now apparent in the 2024 market.